We are on day number 3. So for yesterday, we went through what the ideal value add commercial real estate deal looks like and what asset classes to target that are most recession proof. So I want to go ahead and just ask you guys, what value did you guys get on yesterday's session? Again, it was what asset classes to invest in and how to find your first deal. Just want to hear a little bit about what you guys got from yesterday and make sure you guys are getting value to these sessions. Jeremy, you want to hop in?
Yeah, of course. So I liked the opportunity to um, just the fact that you can purchase a property that needs work, you can get it occupied, you can raise your NOI that ultimately raises the value by the tremendous exponent of whatever your cap rate's going to be. A little bit of investment can go a long way in terms of a long return. So I like that opportunity to see that there's room for growth in again setting the maximum potential value, not um, not buying something hoping to make $1 million and it's only worth the property is only worth maximum $400,000. So looking at something's maximum potential value, and I think that you have to have a vision for that. You also have to have a team of investors who are willing to put the money up, and then also a team of builders who are able to continue to do the work. So, and then also just hiring them out, making sure that the bottom line makes sense. That's where your education from underwriting teaches us the wrong way, teaches us the long haul.
Yeah, no. And again, what I taught you guys so far is that you make your money on the buy. So when you buy a property, you want to make sure that you underwrite it well. You want to make sure that the numbers line up properly so that you're buying in a safe spot. A lot of people buy retail properties. So again, I taught you guys, hey, if you want to go find some properties, a couple areas are websites like LoopNet, like Crexi, but also these are all listed out by brokers, and brokers want to get the maximum value for these properties, which means you're buying retail. So although there's still ways to look on these sites and find, properties that could be distressed or properties that have been sitting on the market for a long time where you might be able to get a good deal, you have to know that most of those are going to be retail properties, and we never buy retail. So always learn not to buy retail, buy value add and something that you can add value to and make that huge spread. John and Angela, what did you guys get out of yesterday's session? Oh, you guys are on mute.
Yeah. There we go.
Okay.
I really liked your talk about the economic occupancy and physical occupancy, two different ways to add value. Obviously physical improvements and rental rate increase, but the also the operational inefficiencies about how much money should be going to advertising and and you can make some money in that improvement by decreasing advertising or increasing it. And yeah, those are the 3 areas I liked and learned.
Awesome. All right. And just one more time, since I just went live on live stream, we just went live. So again, we're going through the 5-day commercial real estate challenge, and we're on day 3 right now. And we're going to be talking about how to fund your next deal, but we were talking about the value that you guys got yesterday in the session where we discussed how to find your first commercial deal and how to buy right. John, can you just repeat that one more time for us? What you got out of yesterday's session?
Yeah, the 3 areas I really liked were the add value via the operational efficiencies, physical occupancy, and economic occupancy, and looking what the current owner is paying out in advertising and figuring out if you can increase that or decrease that and improve your margins.
Yeah, so we look at operational expenses. So one of the things in underwriting when we're looking at a facility is how much are their operating expenses? Is it 25, 35, 45, 50% of their total gross revenue? And if their operational expenses are really high, we find different ways to increase efficiency by reducing unneeded expenses, which in turn increases your bottom line, which in turn adds a multiple to the value of your property. And I mean, a lot of times that can be a 10-time multiple where if you add, $100,000 worth of value, I mean, you can get a much larger selling price when it comes down to sell. So it's really interesting when you actually start seeing the math and start running the numbers. Like every penny you save and you add to the bottom line gives you a lot higher sales price on your exit. And I think everybody in the game loves the formula, and we all know how good it is, which is why we teach commercial real estate. And it's different again compared to residential. So again, I'm saying commercial is better than residential. And again, the reason why is you can't, residential is not necessarily a cash flowing asset. You may have an Airbnb and those are cash flowing, which you could get a little bit higher if you sell an existing Airbnb that's functional, that's doing well. But for the most part, when it comes to just a normal residential home, if you redo the kitchen, if you do certain things, it'll add a little value, but it's not a revenue flowing operation where you can add tremendous value, which you can do in commercial real estate. So that's why I keep telling people, let's try to get out of only doing residential flips and hop into doing commercial flips, commercial buys, commercial value adds. All right. So thank you for sharing that. And as far as for today, I want to make sure that everybody has their workbook. If you guys have your workbook, put it up on screen. If you have a digital copy, just give me a thumbs up. Perfect. All right, so today we are going to be talking about how to fund your first deal or how to fund a commercial deal. And a major reason investors shy away from commercial real estate is because they think they need a massive amount of money. Now, again, some real estate deals, you need a massive amount of money, especially if you're building from ground up construction. It typically takes a lot more money to do those deals. But as a whole, as an investor, if you purchase a operational multifamily or self-storage facility and it's already, you purchase it cash flowing positive, you don't need a massive amount of money to get into those deals. And also you can bring in investors, which we're going to talk about. So day one on mindset, we talked about limiting beliefs. One thing that we have to all overcome is fear to move forward, fear to be able to just take the next steps. For example, to get into investing, to get into commercial investing, to really understand it, to know it, to be able to underwrite it, and to learn to do it well. I think a lot of people will just hit play on the, hey, this really looks cool, but they don't take action. And I think that's the biggest problem is people just don't take action. They're just information seekers. So what I want to challenge you guys is don't be an information seeker. Don't just hit play to just learn, but let's hit play to go and to be able to move forward. And again, fear is what stops us from moving forward. I think, John, we talked about previously, there was a fear that I had and that you said you had was analysis paralysis, getting stuck in analysis paralysis. And, I'm that guy. I need to know every detail about the project, the good, the bad, in order to move forward. And when I didn't have enough information, there's deals that I looked at that I took too long to look at that just flew over my head and flew past me, that I didn't get into. Now, again, there is a learning curve that we all have to go through. And, that's why you have to lean on people and to just have a community, have a good network, have good, solid people around you that are able to take you through these things to help you, to help you grow, to help teach you, and to help you move forward. And that's what helps you get out of that fear, and again, I'm a big advocate for community, networking with other people, other investors, and just being able to bounce ideas back and forth to make sure that, hey, am I making the right decision? What are you seeing that I'm not seeing in this particular deal? So, even with this challenge, you guys are going to meet other people, other investors, new, old. I just would say to connect with other people that are doing what you want to do to get where you want to get. So let's get over that limiting fear. Let's get over those doubts and let's just move forward and just keep pushing along. So for some reason during this challenge, I've been enjoying quoting Donald Trump, maybe because everybody loves him. So he says, I like to think of the word impossible as nothing more than motivation. Again, I like to think of the word impossible as nothing more than motivational. So, and I love that quote because, again, if I think that something is not possible, something's not plausible, but somebody else is do it, I know it's possible because somebody else got there. And if someone else can do it, I know that I can do it and I can achieve it. And it's just a determination of continuing going on and moving forward that is the difference between someone who's a winner and somebody who falls out. So the beauty of commercial real estate is that you have the ability to be creative. And this is what I love about commercial real estate is that there's just so many different ways that you can be creative. Trump wrote the book, The Art of the Deal. And every time I look at real estate, I love to think the art of the deal. The deal is the canvas. How do we write up that deal? How do we, parse out different things for investors, for different partners? How do we do the financing? How do we fund the deal? So there's just so many different pieces, and you craft those pieces in different ways to make a beautiful piece of art. So also in Donald Trump's book, The Art of the Deal, he says, I don't do it for the money. I've got enough, much more than I'll ever need. I do it to do it. Deals are my art form. And same for us. We know that real estate has created so many millionaires. We know that real estate's not going anywhere. It's going to be there for us, for our children, for our grandchildren. It creates generational wealth. And that's why you can focus on real estate and know that, hey, if I'm in this for the long haul and for the long term, and if I stick with it for years, it's going to pay off because that apartment building, that self-storage building, it's not going to go anywhere. That's going to be handed down to the next generation and to my children. And they're going to be able to just be able to get cash flow just for the rest of their lives because of what I did and what I started. So again, it's what you start now that's going to lead to what's going to happen in the future. Day one, we talked about your 1-year goals and just creating the starting with the end in mind. So if we start with the end and we reverse engineer that, we can have some massive results. All right, so from the workbook, we are actually going to go in reverse order today. So we're going to go from bottom up, and I'm actually going to redo this part of the workbook because as I was looking at it, I want to take you guys through essentially what I would think would be I wouldn't say the worst option, but the least desirable option to the best option and how to fund your next deal. So before we start looking at different ways to fund a deal, I think I want to show you guys, and you guys need to understand the difference between a recourse versus a non-recourse loan. So again, before we start looking at the different ways to fund a deal, you need to understand the difference between a recourse versus a non-recourse loan. I think that's really important to know what that is. So starting with a recourse loan, and if you're looking at the bottom of your workbook, we're going to start with filling in the blanks. So one of the 4 ways to fund your deal is traditional bank financing. This is where you finance the property through a traditional bank loan. So through a traditional bank loan, this is what you would call a recourse loan. And a full recourse loan means it's fully guaranteed by the borrower. So you're signing essentially your life away to that deal. If something goes wrong with that deal, the bank can come after the property and your personal assets. So they can, again, come after you personally, which is why this is a little bit more risk when you sign off on a traditional bank loan. Now, do we utilize traditional bank loans for commercial real estate? All the time. But you guys need to understand the different ways to fund a deal and then see which one works best for you and what your risk tolerance is for that type of funding per the deal. Now, with traditional bank lending, you typically would utilize a commercial lender. And on average, they would want roughly 75, maybe to 80% what they call loan to value on the property. So that means they'll give you a loan on up to, let's say, 75% of the value of that property, which would be determined by an appraiser. And you're going to bring in 25% of your own capital, plus you'll need money for improvement costs. So give me a thumbs up if that makes sense. So again, with commercial real estate, you want to understand what the loan to value means. It's a LTV. When you're talking to lenders, you're going to be asking them, hey, what loan to value do you guys borrow on? If they borrow on 85% loan to value, that means you bring in 15% of your own money, which is less than bringing 20 to 25% of your money. So I feel like it's always better to try to bring less of your own money into the deal and have the bank finance a little bit more if possible. But on average, I would say it's about 75 to 80% would be the loan to value ratio on a deal. So for an example, on $1 million deal, if it's 75% loan to value, that means the bank would lend $750,000, and then you would be bringing in the $250,000 to that deal, not including if there's improvement costs needed. So with traditional bank funding, you need more money to fund. Some may bring a private investor to fund the down payment, which would put you in a second position lien, and the improvement costs. So again, you'll have some people that they'll get the bank loan, they'll sign off on it themselves, and then they'll have an investor fund the down payment to fund the rest, which means they're funding essentially 100% of the project through finance. All right. Do you guys have any questions about just traditional bank loan as the first way to fund your next deal? Give me a thumbs up if that all makes sense. All right. So the second way to fund your next real estate would be utilizing equity partners. So these are considered partners in the deal that own a percentage of ownership. This is not considered a loan. So again, look we're second to the top on the workbook. If you want to fill out number 2, again, it's equity partners, which these are considered partners in the deal that own a percentage of ownership, which is not considered a loan. So these are actual partners with ownership, with equity that has been carved out on the deal for them funding the deal. So essentially, if you find the deal as a syndicator, which we call these syndication deals, you are responsible for the work involved to find the deal, to add the value, to manage the property, and to take it to completion until you execute your exit strategy. The investor is responsible for being the sponsor on the loan and bringing the capital needed for the equity shares. So they're typically going to be the silent partner, just funding the project. And then you're going to be the operating partner that's finding the deal, that's doing the rehab work, that's doing whatever is needed to increase the property value. So typically there's a duration when it comes to these types of deals. So if you pick up a value add deal and you're going to do some work to it, you're going to do certain things, improve it, raise rents, do better marketing, whatever value you're going to add. I would say the average duration are 2 to 5 years, normally 3 to 5 years duration wise. So money is usually going to be kept into these deals for roughly that long. And tomorrow we're going to be talking about exit strategies. And tomorrow, one of the exit strategies is, hey, how do you actually keep the property yet still get your capital back that you originally invested into the property? And you might get even more of that capital back to you tax-free. So if you guys stay tuned for tomorrow on exit strategies, we'll go through that a little bit more. And just to share a personal story, so I've funded deals on the 4 types I'm going to show you today. So I've done all of these. I've been into different deals where I've either been a lender, I've been a partner, silent partner, active partner. So with one of these deals, I was the equity partner. So I had partners that brought me a deal and they said, hey, we have this multifamily deal. You put the down payment. We're all going to sign off on the loan. You're going to put the construction funding into this deal. And then the goal is to, either refinance it, take our money out, or we're going to sell off the property and all make a great profit. So this is a syndication deal where I was part owner, they were part owners, but I didn't do any of the work because I provided the capital for the deal. So a lot of people like to be the capital partner that does not really have to do the work, but they're just essentially handing you money because you're giving them a good deal and bringing them on as an investor into that deal. So I think this is a great way to fund a deal is by finding capital partners, bringing them on, saying, hey, I'm going to be, this 2024, I'm going to start looking for these types of real estate deals. Here's my criteria. Here's the type of returns that I like to get. Would you be interested in being my partner into these deals, or can I present this to you if I do find one of these deals to see if you have interest? So definitely keep that one in the bag. A really good way to fund a deal is through partnerships. And, again, I'm giving you guys 30,000 foot view here on this call, but if you dive deeper, there are different ways to structure these partnership deals. There's different ways to form syndications. You form them under a business, you want to create an LLC, and there's a little more details involved, but if you guys have more interest in working with me after this 5-day challenge, and we can dive in even deeper on how to do these things in more detail. All right. So the third way to fund your next real estate deal is through debt partners. All right. So third one from the top is debt partners. So debt partners, this would be a private money lender and can be through a private investor or a hard money lender. So debt partner means they're not getting equity or ownership into the real estate deal. All they're getting is a percentage back as a return. So for an example, if I found a $1 million real estate property and it needed to be funded, and I went to let's say a hard money lender or a hard money brokerage, or if I went to my Uncle Tom, which I don't have an Uncle Tom, I don't think, at least, but and I said, hey, I have this deal, it's $1 million, I want you to be able to fund it, and I'm going to put a certain amount down in the deal. I might be putting 20% or whatever it could be as a down payment. You're going to fund the rest, and I'm going to give you a 10% return or an 8% return or whatever it might be, annualized on that. And once I'm done creating value with that project, I'm going to refinance it with a different type of lending source and give you your money back on that deal. So it's going to be a shorter term loan, because typically these are, I would say, under 5-year loans. Some of them could be 3 years, some of them could be 1-year loans. It's whatever you negotiate with the person lending you the money. So with this, again, it's just paying interest payments for the money earned to a private lender. Now, the advantage with this is we talked about recourse versus non-recourse loans, is this would be considered a non-recourse loan, which means you're not personal guaranteeing this loan. So if a hard money lender, lends on that $1 million project, if for any reason that project goes south, they can only go back and take the property. They can't come after me personally. They can't come after my house, can't come after my wife. They can't, they can't do that because it's a non-recourse loan. So the only recourse they have is to go after the actual property, because the property is the collateral that they have. So with this being said, hard money lenders will really look hard at the LTV, which is the loan to value. So how we said traditional banks may fund you from, let's say, 75 to 85% loan to value. Hard money lenders might give you, let's say, 65 to 75% loan to value. So they want to know that, hey, in the worst case scenario, if this person defaults, I'm getting a 25, 30, 35% discount on this property when I take it back. So they typically have more stricter terms when it comes to lending on the property, because there's a little more risk for them and there's a little less risk for the borrower. The other advantage with this is that this does not show up on your credit report. So typically, if let's say if you're buying a new house and they look at your personal debt to income ratio and they look at loans taken out, if you have your deal structured like this, they usually can't see that you have this loan on the books, which means they don't count that as part of your debt to income ratio. Now, this is typically a little more expensive of a loan when you get a hard money loan versus traditional bank loans. But with that higher cost, there's less risk because they can't come after you personally, because you're not personally guaranteeing the loan. So it definitely has its advantages. I've done deals where I've utilized hard money lending, and I've done deals where I've given out money for loans for other people that needed it for their projects as a private money lender. So I've been on both of those sides, and I think it ends up working out pretty well from what I've seen. All right, any questions on debt partners? I feel like we're kind of flying through this today, which is pretty good, but I want to make sure I can answer any questions that you guys might have.
Hey, Chris. Yeah, Austin here. Hey guys, how's it going? Hey, Chris, I got a question for you on the equity partners.
Yeah.
How would you usually see that split as being the sweat equity partner in a deal, in terms of you doing the work, finding the deal, and then you bringing the money in as your equity partners? How would you usually split that up as far as ownership?
No, it's a great question. And there's multiple ways to split up equity and to structure these deals. I think when it comes to deals, I would say maybe under 3 million or so, under 3 million. It's typically like a 50-50 type split where the investor gets 50% and the other partner who found the deal, who's doing the work, who's managing it, gets 50%. I've seen bigger deals that are, larger, 20, 30, $50 million multifamily, or self-storage deals, and they'll give, maybe 70%, just because it's such a huge deal and there's more that they end up making because of the larger numbers. They can afford to give a bigger piece of those deals to the investors. So there's different ways to skin the cat. Ultimately, it's going to depend on what you and what your partners agree to. And then also, there might potentially be different roles, different expectations. If you're putting in the money and doing some of the work, you should get, a little bit more. If you're relying on somebody else's expertise and they're bringing the deal and just doing the work, and you want to be like the limited partner or the silent partner, then let them do the work. You get your split. You're drinking margaritas on the beach in Cancun, and just wait till the project's done and get your profit.
Should you factor in payments for interest in your pro formas and your underwriting to the equity partners as time goes on?
Yeah, I think it's important to look at, hey, what are some expenses that are going to be happening, let's say during the next 12 months, 24 months, 36 months? Are we going to have interest payments that we need to have a reserve set aside for those payments, and just have that in a reserve so that we're not having to make capital calls later and tell the investors, hey, we have a capital call, we need an additional whatever amount of dollars, which, you know, might upset them at the time because they're not expecting to put more money into the deal. So it's better to ask for, to factor all of those numbers in on the front end rather than bring that up later and not account for those in the back end.
Thanks.
Thanks, Austin. Great questions. All right. Who else has some questions?
Chris, if you got a second too, can you go through the workbook, fill in the blanks one more time?
Yeah. So starting from the bottom up, we're taking a look at the 4 ways to fund the deal. So on the bottom, starting with traditional bank financing. So there's different banks that are known, especially for commercial lending. They love commercial deals. And I'll tell you what, guys, banks have been loving self-storage deals a lot more lately, even more so than multifamily deals. Austin, you're in the self-storage space. You know, you can definitely speak to that. Just, you know, it's
Banks love them. They love self-storage. They've loved apartments too in the past, but they're starting to shy away from it. So anytime you say self-storage, they jump on it really quick. Gives you a good upper hand with the bank system.
yeah. And what's a particular reason, Austin, that you have seen that banks are feeling safer with those self-storage deals?
They see them as one of the most stable assets and investments for them because banks look at it as an investment as the bank's terms. So they see it as more stable than some housing markets, other types of office spaces and stuff like that, just traditionally based on the trends in storage. They've seen it power through, you know, low economies. They've seen it do great in high economies. As things go down, it always just stays like a very even keel as it goes. So they're pushing towards storage right now.
Yeah. And Austin, you can actually speak to this. I'm gonna put you on the hot seat. So Austin does some amazing things. You know, we're looking to partner on some different things, different ventures coming up here. And you know, he actually builds self-storage facilities, but you used to build multifamily apartments and you switched. And I think what I was talking about yesterday was these are both amazing assets. So don't get me wrong, we love them both. But you guys pivoted from multifamily to self-storage. What's the reason that you guys pivoted from multifamily to self-storage?
You know, it wasn't necessarily as much of economical or numbers decision. It was more of the time value in managing the investments. So we manage our own investments, right? So like I manage the self-storage facilities and I was managing the apartments and we have other people hired, and cost to time didn't quite make as much sense. And also if you hire a management company for apartments, they cost a lot more than self-storage if you hired a management company. You know, a management company for self-storage, let's say you hired Public Storage to manage your facility for you, they're going to take about 5% of revenue off the top. You know, you hire apartment complex to manage it, they're going to take, you know, upwards of 15%. So it was just more of a time management and cost to time that was a decision to it. And you can manage 5 self-storage facilities in the same time it costs to manage 1 apartment complex. So it's always, you got to factor that into it as well as being the investor that's managing, more of a sweat equity partner and investment. You got to kind of think about what is this time it's going to take me to keep this investment afloat.
Yeah, and a big thing we've been talking about this past week has been how do we get more by doing less? And how do we maximize potential by doing less? And it's not that we want to do less, but we want to maximize the potential so we can do more of those things and just have exponential returns on our investments. You know, time is money. We don't want to waste our time. We don't want to waste our money. So we always want to try to just get the most value out of whatever we're putting our time into. So thanks for sharing that, Austin. All right, Jeremy, back to your question. So we had traditional bank financing on the bottom. We had equity partners So bringing on partners and carving them out some equity into the deal, which means you're not having to bring your own funds into the deal. We have debt partners, which is a little more hard money lending. So it's you don't have to sign a personal guarantee. It's non-recourse based type lending. And the fourth, I have not shared with you guys just yet. And it's my favorite way to fund a deal. So when structuring a deal, we always want to utilize creative financing. We want to be as creative as we can on how to structure, how to do the financing, the terms, and make sure, again, we're doing things as safe as possible. So off the workbook, this is defined when the seller becomes the bank, and we can call this a non-recourse loan as well. Now, when I said creative financing, the way we utilize creative financing is by utilizing seller financing. So the best part of seller financing is that it doesn't show up on your credit. You don't have to personal guarantee the loan. And again, the property is the only recourse upon default, which again is called a non-recourse loan. But this is where the owner of the property selling ends up becoming the bank and funding essentially they're financing the deal with you, just personally one-on-one. So for example, we're going to go back to, hey, there's $1 million self-storage facility. So we have a smaller self-storage facility. The owner is looking to retire. They don't want to continue managing the property anymore. And, they don't have use for those funds right away if they do sell the property for $1 million. So they want to, a little more, just have some investment money or interest income coming back in. So through seller financing, I can go to this owner and I can say, hey, well, instead of me trying to go to the bank or me going through a lender, why don't you become the lender, you become the bank, and I pay you interest on the property. And my goal is to improve the property, to add value to the property. And if for any reason I default, the property goes right back to you. And I've already put time and money to make the property better. So you're going to get a better property back to you. And also you have my down payment money. So seller financing is one of the best way that I think to structure a deal. And you can structure it whatever way you want to structure. There's a lot of creative ways to structure it with an owner. You can have escalation of interest clauses where, hey, let's start out, let's do a 5-year loan with 5-year interest, and on year 3, 4, and 5, we're doing an escalation of interest. So you get, 5, 6, 7, 8% on those latter years, which means you're going to make more money. So with pitching seller financing to owners, you can take a look at, hey, this is the sales price, but also in addition, over the next, let's say 5 years, for example, you're going to make an extra, $200,000 in interest or $100,000 of interest, whatever it ends up being. And you tack that onto the $1 million that I'm giving you, and all of a sudden you're getting a lot more for your money, just being able to have the deal financed through yourself and you being the bank. So again, it might be a 3-year term, it might be a 10-year term. It just depends on the owner. And the great thing right now, especially coming up in 2024, is that a lot of sellers are starting to become more introduced to the option of seller financing if they actually want to sell their property. And more owners are saying yes to seller financing because you have to find the right person that wants to do that type of deal. But again, with interest rates now being so high, if you have an interest rate at 8% currently, and a seller wants to sell at a 6 or 7% cap rate or return rate, if I go and get that loan with the traditional bank, I'm going to be negative every month into that property. So it does not even make sense for me to buy that property. But if I say, hey, seller, I want to buy your property, I'm going to give you 5%, per year for the next 5 years. We can do an escalation clause after that if I don't pay you or whatever it might be. And that might be the better way to structure the deal, where they can sell the property, you can buy the property and start making improvements. Again, there's a lot of different nuances and ways you can utilize the seller financing method for your advantage as a buyer, and have it be a win-win where the seller is still making some income on that property. And again, if you default and you've already put some money into that property, it's an advantage for the seller for them to get the property back. I mean, if somebody bought my property and it needed improvement, and you came and put in 50,000, 100,000 into my property, and all of a sudden you're saying, hey, I need to be out of this deal, I would happily take that deal back. And now my property is worth more, and go resell it again to somebody else. I mean, would you guys do that as a seller if you didn't need those funds right away? You can kind of still secure your property, and if something goes wrong, you still have it, but you're also making interest income on that. So that's my favorite way of structuring a deal. And that's something that I teach is, hey, whenever you go and you talk to a seller, whenever you go and you talk to a broker, one of the first questions that you want to ask is a seller open to seller financing? And they might say yes, they might say no. And if they say yes, great. If they say no, well, hey, maybe I don't want the deal, or I'm going to finance it through partners, through equity partners. I'm going to finance it through debt. I'm going to finance it through traditional bank lending. But what's good to know is to know all these different ways to fund deals, so that when a deal comes across the table, you're like, okay, well, this deal looks good. Next step is, how do I want to fund this deal? And first question, do they accept seller financing? Are they open to those terms? So you guys definitely want to utilize that. Have that tool in your back pocket when you're out negotiating, when you're looking for your next deal, and know that it's a great tool if they say yes when structuring a commercial deal. Do you guys have any questions on seller financing? No? Is this new to anybody? Some of you guys have already heard of seller financing and structuring those deal structures. Yeah, and again, this has just become, I think it's starting to become more and more popular. And again, it's still an old trick, but I feel like it's not a strategy that everybody really utilizes or thinks to utilize right out of the box. And again, when we talk about being creative in structuring deals, you have to be creative and think outside of the box. And again, that's the art of the deal, is thinking outside the box. All right. So any questions? Molly, so this is new to you. Hopefully this is helpful. Yeah, and hopefully this is helpful to anybody listening, whether you're on here or on the live stream. Definitely want to add some value. I want to be able to give you guys a good 30,000 foot view of commercial real estate and how to do these types of deals and how to get into investing into commercial real estate. Austin, you said seller financing is something most sellers don't know about. Yeah, actually, you're right. A lot of sellers don't even think about, they don't think about seller financing. So when you ask a question, sometimes that sparks up and it's something that they didn't think about before. And they're like, okay, well, you know what? That actually is a pretty good idea. I'm okay to structure it this way. All right. So for the day 3 homework, I'm going to go through that because we only have a few more minutes on this. But day 3 homework that we have in the workbook is, I want you guys to list out any potential private money partners in your contacts that may have interest in investing with you. Now, don't post this in the Facebook group, but I want you guys to keep this. But I really want you guys just have an open mind and start thinking like, okay, who are some people that are in my network that might have interest in investing with me if I was able to find that next deal? Austin, I've got one. Chris or Sam. Well, hey, bring me the deal and let's see. Let's talk. So I think this is a really good exercise to do, is to start listing out like, hey, who are all these different people? And then an exercise is that I actually want you guys to do. Again, if you guys sit here and listen to this, but don't take any action, you're not going to have any results. So my challenge for you guys on the 5-day challenge is to call one of your potential partners, or up to 3, and ask them if they have any interest in investing with you as a private money lender in your new real estate business. So again, call somebody you know, say, hey, I'm going to start investing in real estate in 2024, and I'm going to be looking for a great value add deal. I invest in apartment complexes. I invest in self-storage facilities. I want to know, would you be interested in investing or being an investor in my next deal? Now, again, this can be an equity partner. This can be, you're just paying debt, which means you're just going to give a return. It could be 8% a year. It can be 10% a year with no ownership. But let's just get an exercise out there where you actually go and call some people up and ask them, would you be interested in investing? And they might ask, hey, how much do you think you'd be looking for? Well, do you have $50,000 to invest into a potential deal? Yeah, I do. Well, do you have $100,000 to invest in the next potential deal? Yeah, I do. Actually, I have $500,000 I want to invest if you bring me an amazing deal. And that's what just gets you motivated when you start seeing how many people actually do want to invest into commercial real estate. They just need people to bring them the deals. And there's a lack of people that can really just formulate a deal so nicely and so creatively where this deal just looks amazing when you present it to an investor. And those are the deals that we're looking for. We're not looking for retail deals. We're looking for amazing deals. So I want you guys to do that, to just follow that exercise. And I want you guys to reflect. So again, you don't have to be perfect. This is an exercise. You're going to get better as you guys just keep doing this. So what questions did they have that you were unable to answer? I want you guys to write those down. Were these calls positive or negative? What did you learn from these calls? One thing you need to learn is you may have some negative calls. Just like you may have some negative reactions if you ask somebody if they want to sell their property. You have to be able to overcome these negative reactions to be able to just keep moving forward and pushing through. Again, you're going to have to talk to a lot of people before you find that person that says, yes, I want to sell my property. And you say, yes, I actually like the terms of this deal to buy that property. Or you might talk to a lot of investors and you'll get a lot of, yes, I'd love to invest with you and support you. No, actually not interested in investing. Totally fine. And continue moving on. All right. So that completes day 3 of the 5-day challenge. I'm going to go ahead and release the live stream right now. And then everybody who is on the Zoom, let's have some more Q&A.